Chapter 3 is a very important chapter in Accounting 211. It sets the really a major framework as far as what you're going to be doing in all the future chapters in this class, because this chapter focuses on transaction analysis and the recording of individual transactions. In the first two chapters, you got a sort of a sneak peek at what the primary financial statements that are prepared are. But those financial statements and all the numbers that you saw in those statements were all a function of individual transactions being recorded throughout a company's life. So now we get into chapter 3, how to record individual transactions so that at the end of any given period of time you can create financial statements. So you're going to want to pay a lot of attention in this chapter and do a really good job of reading through everything and really getting it. Without any more delay here, um, study objective 1 here deals with the effect of business transactions on the accounting equation. We learned this equation at the beginning in chapter 1, and this first study objective runs you through a whole list of pretend transactions for a fake company, and it helps you understand what the effect on this accounting equation is of individual transactions. And then after, when we get into study objectives 2 and 3, we'll learn how the recording process of individual transactions really works. So I'm not going to go through all this for you, except for to say that we'll see getting into these events down here and how they affect the accounting equation. But this illustration right here is a really good thing to kind of have memorized in your head, because this accounting equation up top can be broken down like this. This equity section of the accounting equation consists of a bunch of different things. Common stock is all the money contributed by shareholders to the company, and then retained earnings is all the profits that have been retained inside the company. And then retained earnings is derived by revenues which are created minus expenses minus dividends. So basically, this is net income, revenues minus expenses, and then minus dividends. So if you recall from the retained earnings statement earlier I think it was in chapter 1, maybe chapter 2, it showed you retained earnings statements and had you calculate some amounts in retained earnings statements and prepare some, and this was the formula. So this shouldn't be any surprise right here. So you can see some of these events: investment of cash by stockholders. In this pretend scenario, this company got cash of $10,000 by investors in exchange for common stock. So that means that the company's getting cash, so we're recording an increase to cash, or we need to have an increase to cash be recorded, and common stock is going up by $10,000. Um, it's not that the company's getting common stock; it's that the company has issued common stock. So that's what the positive 10,000 is for. So you can see this accounting equation always stays in balance. The asset side goes up by 10, and the liability and equity side goes up by 10. So, and that's going to be a key in every transaction that you ever record, is keeping this equation in balance. All right, so I'll let you look at the rest of these transactions and look at the effect on the accounting equation of each of these, making special note of how the accounting equation stays in balance.